Section 1. The crossroads of capital syndication versus SPY. You've worked hard, saved diligently, and now hold $20,000. A decision looms large. Where should you invest? Two paths beckon: real estate syndication and the SPY ETF. Real estate syndication, a collective investment strategy, pools resources to acquire larger assets. Imagine owning a slice of a multi-million-dollar apartment complex. This path promises passive income and potential appreciation. On the other hand, the SPY ETF, mirroring the S&P 500, provides broad market exposure. It's a simple way to invest in America's leading companies. Syndications offer the potential for double-digit returns, fueled by rental income and property appreciation. The stock market, represented by the SPY, has historically yielded respectable returns. Your decision hinges on your risk tolerance, investment timeline, and financial goals. Are you seeking passive income streams or rapid growth? Do you prefer tangible assets or the liquidity of the stock market? Section 2. Real estate syndication, pooling for prosperity, bracing for storms. Real estate syndication offers a compelling investment opportunity, particularly for those seeking passive income and long-term growth. By pooling resources with other investors, you can access larger, potentially more lucrative properties. This avenue allows you to leverage the expertise of experienced sponsors who manage the investment from acquisition to disposition. Investing in a real estate syndication is akin to becoming a silent partner in a business. You provide capital while the sponsor handles the day-to-day operations. This structure allows you to reap the benefits of real estate ownership without the headaches of property management. However, it's crucial to understand the risks involved before taking the plunge. One primary risk is the lack of control. As a passive investor, you relinquish decision-making power to the sponsor. Thoroughly vetting the sponsor's track record, experience, and integrity is paramount. Be prepared to hold the investment for the duration outlined in the syndication agreement, typically 5 to 10 years. Section 3. SPY ETF, riding the market roller coaster. The SPY ETF presents a different set of opportunities and challenges. Tracking the S&P 500, this ETF offers broad exposure to the U.S. stock market. Investing in the SPY ETF is akin to placing a bet on the overall health and growth of the American economy. One of the most appealing aspects of the SPY ETF is its simplicity. With a single purchase, you gain exposure to a diversified portfolio of blue-chip companies across various sectors. This diversification helps mitigate risk. If one sector underperforms, others can potentially offset the losses. However, this simplicity comes at a price. While the SPY ETF offers diversification, it lacks the potential for outsized returns that individual stock picking or niche investments might provide. The stock market is influenced by a myriad of factors, including economic data, geopolitical events, and investor sentiment. If you're risk-averse or need access to your funds in the near future, the SPY ETF might not be the ideal investment vehicle. Section 4. Liquidity, cash flow conundrums. Liquidity, the ease with which an asset can be converted to cash, is a crucial consideration for any investor. Real estate, by its very nature, is illiquid. Selling a property takes time, often months, and involves various costs. In contrast, the SPY ETF offers high liquidity. Traded on major stock exchanges, SPY shares can be bought and sold with ease during market hours. This liquidity provides flexibility. However, this ease of liquidation can be a double-edged sword. The choice between the illiquidity of real estate and the liquidity of the SPY ETF hinges on your individual circumstances and investment goals. Economic cycles, characterized by periods of expansion and contraction, exert a significant influence on both real estate and the stock market. Understanding these cycles and their impact on your investments is crucial for navigating the financial landscape. Real estate, often perceived as a safe haven asset, tends to perform well during inflationary periods. As prices rise, so do property values and rental income. Moreover, real estate offers a tangible asset that can provide a sense of security during economic uncertainty. The stock market, as represented by the SPY ETF, is more susceptible to short-term economic fluctuations. During recessions, corporate profits decline, leading to lower stock prices. However, the stock market has historically rebounded strongly from downturns, often exceeding previous highs. The impact of economic changes on your investments depends on your investment horizon and risk tolerance. Diversifying your portfolio across different asset classes, including real estate and stocks, can help mitigate the impact of economic cycles. A well-diversified portfolio is like a sturdy ship, better equipped to weather the inevitable storms in the financial markets. Navigating the intricate world of investments requires knowledge and expertise. Both real estate syndication and investing in the SPY ETF demand a certain level of understanding, albeit in different areas. Real estate syndication necessitates due diligence. Thoroughly vetting the sponsor's experience, track record, and the specifics of the underlying property is paramount. Understanding financial statements, market analysis, and legal documents is crucial for making informed decisions. Investing in the SPY ETF, while seemingly simpler, still requires a basic understanding of stock market dynamics, economic indicators, and investment principles. Fortunately, a plethora of resources are available to educate investors of all levels. Books, seminars, online courses, and financial advisors offer valuable insights and guidance. Investing in your financial education is as crucial as investing in the assets themselves. The more you understand about your investments, the better equipped you'll be to make informed decisions, manage risk, and achieve your financial goals. The tax implications of an investment can significantly impact your net returns. Both real estate syndication and the SPY ETF offer unique tax advantages and disadvantages. Understanding these nuances is crucial for maximizing your after-tax profits. Real estate syndications offer several tax benefits, including depreciation deductions, which can offset rental income, and the potential for long-term capital gains treatment upon the sale of the property. These tax advantages can significantly enhance the after-tax returns for real estate investors. Investing in the SPY ETF also carries tax implications. Dividends received from the ETF are taxed as ordinary income, while capital gains are taxed based on your holding period. It's essential to consult with a qualified tax professional to understand the specific tax implications of each investment option based on your individual circumstances. Tax laws are complex and subject to change, so staying informed is crucial for optimizing your tax strategy. Carefully consider the tax implications of your investments to ensure you're maximizing your after-tax returns. Section 8. Inflationary hedges safeguarding your wealth. Inflation, the silent thief of wealth, erodes the purchasing power of your money over time. Hedging against inflation is crucial for preserving and growing your wealth. Real estate has historically served as a reliable hedge against inflation. As prices increase, so do property values and rental income. This positive correlation provides a natural hedge against inflation, safeguarding your investment from the erosive effects of rising prices. The stock market, represented by the SPY ETF, can also provide some inflation protection. Companies can often pass on rising costs to consumers through higher prices, protecting their profits and in turn, potentially boosting stock prices. When choosing investments to hedge against inflation, it's essential to consider their historical performance during inflationary periods. Real estate, with its tangible nature and potential for rental income that rises with inflation, has often proven to be a more reliable hedge than the broader stock market. Section 9. Diversification, the prudent investor's shield. Diversification, the cornerstone of prudent investing, involves spreading your capital across different asset classes, sectors, and geographies. This strategy aims to reduce risk by ensuring that the poor performance of one investment doesn't cripple your entire portfolio. Real estate and stocks, represented by the SPY ETF, offer diversification benefits by providing exposure to different sectors of the economy. Real estate, a tangible asset class, often moves independently of the stock market, providing a valuable counterbalance to a portfolio heavily weighted in stocks. Investing solely in the SPY ETF, while providing exposure to a diversified basket of stocks, still concentrates your risk in the stock market. A market downturn could significantly impact your portfolio value, even with the diversification offered by the ETF. A balanced approach involves diversifying your portfolio across both real estate and stocks. This strategy provides exposure to different asset classes with varying risk and return profiles, potentially enhancing returns while mitigating overall portfolio volatility. By spreading your capital across different investment avenues, you create a more resilient portfolio capable of weathering market fluctuations and achieving long-term growth. Section 10. Long-term vision, compounding wealth over time. Successful investing requires a long-term vision. Compounding, often referred to as the eighth wonder of the world, is the process of generating earnings on your initial investment as well as on any accumulated earnings. Real estate syndication, with its potential for passive income and appreciation, can be a powerful engine for compounding wealth over time. Rental income, reinvested back into the property or other investments, can generate additional income, creating a snowball effect that grows your wealth exponentially. The SPY ETF also benefits from the power of compounding. Dividends paid out by companies in the S&P 500 when reinvested purchase additional shares, generating further dividends and compounding your returns over time. The key to unlocking the magic of compounding is time. The longer you stay invested, the more time your money has to grow. Patience, discipline, and a long-term vision are essential for harnessing the power of compounding and achieving your financial goals. Section 11. The verdict: which path aligns with your financial goals? The decision to invest in real estate syndication or the SPY ETF hinges on your individual circumstances, risk tolerance, and financial goals. There is no one-size-fits-all answer. Each investment avenue presents unique opportunities and challenges. Real estate syndication, with its potential for passive income, tax advantages, and inflation hedging, aligns well with investors seeking long-term growth and cash flow. The SPY ETF, offering broad market exposure, simplicity, and liquidity, suits investors comfortable with market volatility and seeking a hands-off approach to investing in the stock market. Ultimately, the best investment strategy is one that aligns with your individual financial goals, risk tolerance, and investment timeline. Carefully weigh the pros and cons of each option, conduct thorough research, and consider seeking advice from a qualified financial advisor. The more you know, the better equipped you'll be to make informed decisions and navigate the complex world of finance.